Apple Stock Analysis, August 13th, 2026. We're doing a deep dive into services segment margin growth. Apple's services generated $30.74 billion in quarterly revenue at a 75.6% gross margin. But here's what really matters. Services represented only about 28% of Apple's revenue, yet generated roughly 42% of its gross profit. When you see a disproportionate share like that, it's immediately clear why this segment is Apple's actual profit engine. You know, they don't just sell devices anymore. They've essentially built this massive, high-margin ecosystem right on top of that hardware. So let's unpack these Q3 2026 headlines. Total revenue came in incredibly strong at $109.42 billion, which is up 16.4% year over year. Now, products revenue, we're talking your iPhones, your Macs, made up roughly $78.68 billion of that total, and that operates at about a 40.1% gross margin. But the real story is sitting in the services lines. Services revenue hit $30.74 billion, up 12.1% year over year. And from that revenue pool alone, Apple extracted a massive $23.25 billion in gross profit. Diluted earnings per share jumped an impressive 29% to $2.02, pushing the total company gross margin up to 50.1%. But before we just take that 50.1% margin at face value, there's a pretty important caveat we need to cover. Right, so that 50.1% company gross margin wasn't entirely from organic operations. Apple disclosed that tariff refunds actually contributed roughly 2 percentage points to that total figure and added $0.11 to the diluted EPS. As investors, it's absolutely crucial that we separate the underlying structural margin improvements, which are heavily driven by that services mix, from temporary one-time accounting benefits like this tariff refund. The true structural story is happening inside the margin bridge. The margin gap between Apple's two main businesses is honestly staggering. Think about it like this. For every single dollar of revenue generated by the products segment, Apple sees approximately 40 cents in gross profit, mostly because of heavy physical inventory and manufacturing costs. But look at services. For every dollar of services revenue, Apple generates approximately 76 cents of gross profit. It has incredibly low direct cost intensity. This massive gap explains exactly how a mix shift towards services lifts Apple's consolidated gross margin. Even if the services margin percentage doesn't grow another inch, just expanding the total revenue pool at a 75.6% margin is going to add billions of dollars of gross profit straight to the bottom line. So what does the multi-year trajectory look like for this segment? If we track services growth from fiscal 2023 through Q3 2026, you'll notice a really steady climb in both revenue and margin up through FY 2025. Back in FY 2023, services generated roughly $85.2 billion at a 70.8% margin. Fast forward to the start of FY 2026, and we see margins peaking around 76.5% and 76.7%, before stabilizing right at 75.6% in Q3. The crucial point here is that Apple has largely already captured those massive scale and mix benefits in its services margin. Since the scale benefits are essentially plateauing around this mid-70% range, future upside for Apple's bottom line is going to depend heavily on sustained revenue growth, rather than banking on huge jumps in the margin percentage itself. Okay, so how do they sustain that revenue growth? We have to look at the services ecosystem flywheel. Basically, Apple leverages its massive install base of devices to drive high-margin recurring revenue across several key verticals. First up is advertising, which scales effortlessly across all those active devices without requiring Apple to manufacture anything new. Then you've got the App Store, which is just a monster revenue engine fueled by developer activity and Apple's commission structure. Add in cloud services like iCloud, along with subscriptions like Apple Music, Apple TV, and AppleCare, and you end up with incredibly predictable recurring revenue. Ultimately, all of this creates serious ecosystem lock-in. When a consumer owns an iPhone, an iPad, and a Mac, they're monetized repeatedly over the years, which drastically increases their lifetime customer value and easily supports these high margins. If you're finding this Apple stock breakdown useful, subscribe to Fox of Wall Street, like this video, and share it with another investor who follows AAPL. Let's pivot to the current stock setup snapshot as of today, August 13th, 2026. AAPL was trading around $303.11, slightly up from its previous close of $302.25, but it's still sitting below its 52-week high of $344.57. Right now, Wall Street's average analyst target is roughly $330.45, though the range there is incredibly wide, stretching from $245 all the way up to $400. Now, keep in mind, these analyst targets are purely market estimates. They are not guaranteed intrinsic values or outcomes. And the lower end of that range is being driven by some very real headwinds. Just recently, Jefferies actually downgraded Apple to underperform, slapping a $263.66 price target on the stock. Their reasoning? It stems largely from fears over the future iPhone roadmap and broader hardware economics. Which brings us right to the ultimate analyst debate currently surrounding the stock. The bull case argues that services can comfortably maintain this low to mid-teens growth rate. They believe the installed base will keep expanding, the service mix will continue to improve, and most importantly, new artificial intelligence features are going to create massive new ecosystem monetization opportunities. On the flip side, the bear case worries that services growth is bound to slow down dramatically just given its massive size. Bears are quick to point out increasing App Store regulations, rising infrastructure costs for AI and cloud computing, and potential hardware margin compression. Given Apple's premium valuation, bears argue these factors could severely limit upside. To help you navigate this debate, here is an actionable investor scorecard. When Apple's next earnings report drops, these are the 5 metrics you need to watch together to gauge true earnings quality. Number 1, services revenue growth. You really want to see this comfortably above 10%. Number 2, services gross margin percentage. It needs to hold steady in the mid-70s. Number 3, total company gross margin. We want to make sure it's expanding without relying on one-time tariff tricks. Number 4, products margin and revenue. This ensures the hardware side isn't compressing too much. And finally, number 5, diluted EPS growth. Monitoring these 5 metrics is going to tell you for sure if the profit engine is still running smoothly. So our core takeaway today is clear. Apple Services has successfully evolved from a supporting ecosystem feature into a major profit engine. The sheer scale of services generating approximately 0.76 of profit on every single dollar gives Apple a really powerful lever to sustain its earnings quality. But here's the ultimate question for investors. As regulatory pressures mount and AI infrastructure costs rise, can Apple's services segment keep expanding fast enough to offset hardware volatility and high valuation expectations? This video is for educational and informational purposes only and is not financial or investment advice. Always conduct your own research before investing.